Relative value strategies are one approach, and they are non-directional, and they tend not to correlate with either fixed income or equity markets. Relative value strategies are applied when you identify mispricing between securities in a market, and they have to be related in some way, and generally then that mispricing will correct. You can profit from that mispricing, and then you can move that profit into another opportunity. These kinds of strategies also tend to deliver more stable returns than investment strategies where you have to invest or take bets on the market direction. The reality is that derivatives actually help you to reduce risks in a portfolio. And an example of a derivative is a bond future. And a bond future obligates the contract holder to deliver a bond at a specified price at a specified date. Now, because those two securities are linked to each other, in general you would expect them to trade in line with each other and for them to be exposed to the same market risks. So one example, I'll give a really simple example that we use in our portfolios, is suppose an investor identifies a mispricing between bonds and a related futures contract. It might be that the bond is trading cheaply relative to the futures, so the investor could buy the bond, sell the futures contract, and then what's happened there is you've isolated the mispricing between the two securities, but you've stripped out any of the market risk, and in this case it would be duration, which is interest rate risk. Inefficiency exists because there's different market players who need to take positions in certain types of contracts. So, for example, insurance companies have to invest in certain types of assets so that they satisfy regulatory requirements. And then a lot of hedge funds and other market participants will use futures contracts to hedge out risk. And so you've got demand for the physical assets coming from one type of investor, and then a demand for the derivatives associated with those physical assets coming from a different type of investor. And at different times they'll have different demand levels, and that's what drives the mispricing between the two securities. So the first really important thing is market size and turnover. So it's really important that the holdings in a portfolio are sized modestly relative to the rest of the market and the overall turnover. The second is diversity of the market participants. So you want to have a deep market with various different types of market participants so that you have a stable balance between the buyers and the sellers. And then the third really important factor is liquidity support, regulatory liquidity support. And this means that central banks will be supporting the liquidity in, say, the government bond market. And actually we've found that very high quality government bonds have always maintained liquidity during even the worst market crises.